Welcome everyone to Macro Matters, our bi-weekly conversation about the macro events and dynamics that are happening in the markets and that matter for our members in the finance industry. Today is February 9th, 2022, when we're recording this. My name is Lotta Moberg. I'm with the Dynamic Allocation Strategies team at William Blair, and with me, as previously, I have Rich Excell and Tony Zhang, both of the Geese College of Business at University of Illinois. Welcome, guys.
Nice to be with you. Hi, Tony. How you doing today?
Hi, Rich. Hi, Lotta. Thank you for joining. I'm very happy and very excited today, actually, because the market has a very nice rebound. And especially that we're going to discuss a very exciting topic.
We are. We thought we would discuss something really interesting, and it's not the markets of the day, so we'll do that next time. Okay. We thought we'd cover the very intriguing topic of value and growth, what it actually means, what can we expect from it, does value outperform over time, and so on and so forth. So what better people to talk about this than Tony and Rich. And Tony, why don't you start off, give any high-level thought you had, and you can kick it over to us.
Yes, because we have the very bad starting of this year with S&P actually down like more than 10% by the end of January. Now, people actually started to talk a lot about whether this year might be the year that value might outperform growth. Actually, the value and growth that by definition itself actually vary and depends based on the context. Maybe Lotta, why don't you just give an introduction about how industry actually construct the value and growth index adopted mainly in the financial market?
Sure. So I was looking at this in the context of the S&P, and that's one thing that many people will be looking at. And if you take all the steps that they're going through, you kind of realize that there's no real clear way of having a feeling for value growth. It becomes very much an aggregate. It becomes kind of abstract. So on the slides that we're sharing here, you're seeing the three factors of each kind of a growth of value that the S&P is using. And as we'll get to, S&P is of course not the be all and end all. Others have other methodologies. But let's take this one as an example. So you have the growth factors. You have backward-looking growth in earnings, earnings per share, okay? You have also a backward-looking growth number of sales, okay? And then you have a momentum of the price. So it's like, it's over current price in both of these two components. And then we also have the price. So they all have to kind of move upward together. And note that it's not, a lot of people would say, well, growth companies are those that are expected to have higher growth. If you're a fundamental investor, you believe that something that has grown really quickly in the past will have a slower growth going forward. But this is kind of assumes that it has to be backward looking. And I actually went through and looked at some old financial analyst journals, the first ones that were published in the early 60s. And they had discussions about this. And it was really intriguing to read. And when I read it, I haven't looked through the methodology. And I thought it seemed so obsolete because they talked about the companies that had grown in the past. They had those were going to be the growth companies. And it turns out this is exactly the methodology that we're using for growth today. So the bottom here, you're seeing the value factor. A little bit more straightforward. But there you have ratios. This is not a change thing. It's about the book value and the earnings and the sales per price. So you divide it by the current market price. So you have earnings and sales, which is an income statement issue, and the book value is on the asset side. And book value, of course, has its own problems. As you might know, we don't count intangibles very well. So there it becomes an issue of like whether that's counted right and whether that is behind like the value not being valued properly. Okay, so we got these three. So then what they do is they give them a number score for each one of these, and then they average the score so that each company has a growth score and a value score, and then they rank them with all the scores, okay, from top to bottom, growth, value, and then they take the ratio of a company's ranking of growth versus value. And then you get a list of the ratios, okay? And then they take the third top of that, then becomes the growth companies, and the bottom becomes the value companies, and everything between is like not specified. So there you go, right? A little bit fast as I'm going through this, because I had to read it to really like, oh, I can see it, I can visualize what's going on. But it's certainly not, I was intrigued by just reading about it, because it's not really intuitive. When you have to go through many of those steps, you think that value and growth is a thing, tangible thing. It's constructed, and it's clear when you look at how many steps they're going through that you could have done this another way. So that was my foray into the S&P as an example. Maybe Rich, you want to take it from here and look into other issues with the methodologies here. What actually is the result of this, and what other methodologies are out there too.
Sure, and I would actually add that middle third that you're talking about gets evenly split between growth and value. And so it really is that the stocks that are neither pure growth nor pure value end up in both of those indices. And so that makes it even confuses it just a little bit more too. But I think while you're talking about the pros and cons of the approach, we have to acknowledge that usually when we read something in the media, hear something on TV, or even see it in Wall Street strategist reports, that value growth that you're talking about is typically the relationship that people are using. And so they never really understand how fundamental investors can say that value works over a longer period of time. And so if you look at this, I've brought up the S&P 500 value index versus the growth index. So the value index is in white and the growth index is in blue. And you can see that for this century, I've basically chosen the last 22 years, that growth has clearly outperformed what value has done. So this is up 300 odd percent for growth over this century, and 350-ish% and 270% for value. So clearly you look at this and you say that growth has absolutely outperformed value. And while value might have been doing well earlier in the century, it's been quite a different picture of late. So if we narrow down and say the last 10 years, you can clearly see where investors are skewed or slanted towards growth when they look at something like this, because the growth as measured by the S&P 500 in this metric has almost doubled the performance of value. And as we know, a lot of the investors, in fact, I think the metrics are about half the investors now have come into the market post the financial crisis. And on the professional front, this is all they will have seen in their career. So they're going to be looking at saying growth has basically always worked relative to value. But as Tony was mentioning earlier in the podcast, it really matters how you construct the index. And because if you look at these two indexes, what they don't do in sorting the companies as they were is they don't neutralize for the sectors. And so you end up with some sectors that are heavily represented or heavily weighted in a value index, or heavily skewed or weighted in a growth index. So especially in the last 10 years, the technology sector has a heavy weight in the growth index, while energy and financials have been heavily weighted in the value index. And it makes some sense, right? Because if you think of what is a value stock or value sector, it's typically something that's out of favor, maybe a little bit broken. Post the financial crisis, clearly the financial sector was struggling, certainly early on, and has been a little bit out of favor. With ESG investing, et cetera, as we kind of talked about last time, energy sector has been a little bit out of favor. And so these sectors being out of favor, you would kind of expect them to be heavily represented in the value index. Similarly, the most of the growth we've seen in the digitization of the economy, and especially post-COVID, when you see this spike here, has been in the technology sector. So there's a logic for why that these representations are there. But what it means is that really you're getting a relative sector move as well as a relative factor move when you're looking at these two indexes. So if you actually try to sector neutralize these, and I'm using the Bloomberg factors here, where they look at a pure value versus a pure growth. And so what they do is they do a similar methodology where they're looking at growth factors and value factors, but they neutralize them on within each sector, so that the indexes that they've created don't have a sector weighting. And if you look at this, you see a materially different picture than what we looked at before. But now you look at it, and value over the last 22 years has meaningfully outperformed what growth has done. In fact, growth has basically been flat on a sector neutral basis for all of this century, which I think would shock most people when you look at that. Whereas value has had more than double the performance that growth has had on a sector neutral basis. And again, even over the last 10 years, it's been a little bit more mixed. Clearly, growth on a relative basis versus value at a sector neutral level has done a little bit better than it had previously. But you can see here, the blue line where value had really has really been underperforming was from 2017 to 2020, and then they had a sharp snapback in the last year or so. Whereas growth had some meaningful post-COVID positive response on a relative basis and absolute basis. And that's starting to pull back a little bit. So I guess the punchline to me is how you construct the index really matters to how you view whether or not growth or value is really working in this world. And I didn't go into the deep
here for a second, because
yeah.
I really think about a very interesting point right here by looking at this graph. Now here we look at the graph, the value really actually outperformed the growth by 2019, right? Actually, this suddenly made me think about the battle between Warren Buffett with it's a Bill Ackman. I think that, right, they bet which one actually is going to win over the index. Like I think it's especially to saying that if value should outperform the growth index over the past 10 years, and we suddenly see a shift right here. It's almost at the end of 2020 when we like a lot of value investors or value hedge fund manager really suffer. Now it's since the beginning of year 2021, we definitely see some of the condition improve for value investor, and it's more actually accelerating by the beginning of this year. When we think about value investment, investor immediately will think about the Warren Buffett ARK. ARK on the other end, it would be the growth opposite. Now we will think about the I think the Berkshire Hathaway investment here. Now we definitely see some component or maybe time shift. It's really a moment that for the investor really to ponder right here whether the change for value and growth was shifting will actually last longer. And I find it really quite interesting for you to talk about. It's like how we actually look at the component or composition of the value and growth that would actually make a difference. I would like to actually hear more of your ongoing discussion. Lotta, what do you think?
No, I was just gonna say, because I was gonna ask you a question, Tony. I mean, I think when to Lotta's point, that the discussion on value versus growth has been going on for decades, right? And I think a lot of people can reference the Fama French models, either the 3-factor model or the 5-factor model, as kind of some of the first discussions on value as a factor. But I was going to ask you, nowadays it seems that in the quantitative finance, people use way more than 3 or 5 factors when they're building the models. Isn't that right?
Oh, definitely. Right now, Fama French 3 factors model, or right now with the extended one, Fama French 5 factors model would just use it as the golden benchmark for the industry to evaluate, or for academia to evaluate the investors or hedge fund manager, whether they can really create the alpha. But from the industrial perspective, I have seen lots of hedge funds using more complicated value factors. Lotta actually mentioned a very good point right from the beginning when given the introduction about the industry, especially with S&P construction of the value factor. Now, what Lotta has said is really just textbook introduction about how the textbook academia point of view construct the value factor. They sorted out the investment universe based on certain factor, value factor, for instance, the price to book ratio, and sorted based 3 parts. Now, with given either we have a higher ranking score for the top 1/3, and we have the lowest ranking score for the bottom 1/3, using that 1/3 average performance and trying to compare the difference to construct whether maybe one group with top 1/3 will outperform the bottom 1/3 to actually determine whether the value actually has any premium. I think that's a very nice introduction for Lotta right at the beginning for academia. But from industrial perspective, definitely, I think it's way more complicated. than what we just use the Pharma French three factors model. However, Rich, as what you're saying that it's always rare for hedge fund manager to create alpha based on just purely Pharma French three factor over the past 10 years. It's like a lot of academia researchers just argued that alpha created maybe 1 year by some managers would disappear over the next years. I don't know whether that will be true, but based on the research, it seems to be the case. It's always very difficult to outperform the benchmark or index.
It certainly is, but I think what we can see from some of this performance is that sometimes beta to a factor might even be better than alpha.
Yes, people sometimes will actually just make a confusion between the beta and alpha. Actually, when we actually analyze the real performance of the hedge fund manager, we definitely need to look into the relative performance over three factors model. I think that's always very critical.
Rich, these slides, it's really nice that you put this together. Do you want to continue and see, are there more slides that you have?
Well, absolutely. So this is the first thing, excuse me, I want to talk about is that, when we look at that, just back to that S&P 500 value versus growth, you can see that if we look at the late 2000s tech bubble period, we start to see that perhaps maybe we would see some correction. But I think a bigger thing that we might want to talk about here, and I wanted to get your view on this, is back in 2020, there was a CFA Institute blog on the question of value versus growth. And so in this, they kind of spoke to the low interest rate environment and why the low interest rate environment was actually more conducive for investing in growth stocks versus value stocks. And so I guess the question I would have for you before I kind of go to the next slide and get to the punchline is, can you think of why that might be the case, that growth stocks should do better in a low interest rate environment, or value stocks should do worse?
I know, teacher, I know.
Go ahead.
Yes.
Because with growth stocks.
Well,
okay,
from academia point of view, people would just immediately adopt what they call the DCF model, discount cash flow model. When we have a low interest rate, that the discount rate will actually go lower. However, it's not that being so simple or straightforward. People just utilize the risk-free rate, which is actually set up by Federal Reserve or central bank to actually put into the denominator, right? But in general, people use the DCF model to calculate the intrinsic value of a company or stock. In low interest environment, people will anticipate, here the discount rate would definitely go lower. So in that case, like any future growth, especially the cash flow could be created from a growthy company, like the one owned by Cathy Wood's fund, right? We actually have a much lower discount rate and actually inflate the current valuation for the companies right here, right now. I think that's my general answer. Is that right?
What do you think, Lotta?
That is correct. Tony gets the prize. And I would add to that, that means that net present value is high. It doesn't mean that returns are high. If you assume that people are using the correct discounted cash flow model, then everybody's going to value the growth stocks, the growth companies higher all at once. The yield curve, forward-looking yield curve shifts down, the value goes up, and it's all done with it. So it's always this tricky. Like you hear people also saying that, they're going to outperform. It's like, well, okay, that assumes that you think that the expectations of lower rates are not baked into the price right now, and there's going to be more of that to come.
Well, if we think about the DCF models that Tony was referencing, so if you think about growth stocks, those would be what I would call high terminal value investments, because most of the value is coming from the terminal value of the entity and is not coming from the cash flow near term, whereas value typically is a shorter, you're getting more cash flow along the way. And so really from a duration standpoint, growth is a long duration asset and value is a short duration asset. And so if we're in a world where maybe interest rates are moving higher, what's your view, Lotta? Would you rather be long duration or short duration?
Well, it all depends on what I believe is baked into the price, right?
Absolutely.
I mean, the obvious answer is interest rates moving higher. You don't want to be high duration, right? You want to be in the value bucket.
Right. So no, you're absolutely right. You generally would would prefer value type of investments
Right.
as the markets are correcting. So I just took a quick look and said, okay, what is the relationship to interest rates? Again, just a very quick overlay of the 10-year treasuries versus the same value and growth factors I looked at. And so on this one, I looked at, this is the sector neutral value versus growth, where I can compare the pure value versus the pure growth and the US 10-year interest rate. And as you see, really over the last 20 years, there is not very much of a relationship at all on a sector neutral basis, because perhaps a lot of that is baked in the cake, as you're talking about. Whereas if I look at this on the S&P 500 value versus growth relationship, and so the blue line is S&P 500 value divided by S&P 500 growth, and then the white line is that same 10-year interest rate, you see a little bit more of a relationship. It's still noisy and choppy, of course, because things get priced in ahead or whatnot, but there's a bit more of a relationship. But again, I think that comes back to a lot more to the sector effects and not so much the style or factor effects that we're talking about.
And how do we explain that then? That's interesting observation, right? So just to recap what you just said, you say that if I take a very commonly used way of looking at value and growth, there seems to be a very, very good correlation between an interest rate and the ratio between them, where as the interest rate goes down, it's the growth stocks that outperform, right? But if I sector neutralize it, and we might want to clarify what that actually means, then you don't see that relationship, right? So I want us to step back a little bit and think about, this becomes there's a lot of methodology talk here, and it's important. When we're talking about neutralizing something, right? We're looking at, instead of looking at the whole universe, you're dividing it into buckets, and you look at each bucket within the bucket. So I call this a sector, that is, say, financials or IT or something like that. Do I have that correlation between two factors within that bucket, right? Now, the thing is with that is you can there are a lot of buckets that we can create, right? And if you keep creating a lot of buckets, at some point you run out of what we call degrees of freedom, right? So, because we brought up other factors, and in theory, Tony, who's really into the quantitative way of thinking about this, he could jump in and say, well, I have 100 factors for you, and I want to control for those factors. And then we can see, like, your sectors, like, that's 11 factors, that's nothing. So I want to have other factors in there. So we can, in theory, go on and say that I like my factors, you like the sector factors, I like other factors. And it's, at one point, we run out of data to work with, so to speak, because you're throwing too much factors on it. How do we deal with that problem? Like, how do we know that your sector stuff is the right way to bucket things, right? It could be other things, it could be other pharma French factors too.
Yeah, Richard, do you want to start with the definition of the sector neutral?
Well, what I mean by the sector neutral is that you talked about before about taking the entire S&P 500 and dividing it 1/3 into value stocks, 1/3 into growth stocks, then having that middle group. Think about doing the same thing, as you mentioned, in the 11 sectors. And S&P has the global industry classification standards, the level 1 GICS, if you will, and you do that same sort of methodology on whatever value or growth metrics you want to use, and you look at them on each sector, and you divide each sector into whether you want to look at it top decile, top quintile, top quartile, top half. That's up to each individual manager. And then they look at it at the factor on each of the sectors. And so when you construct the index, then you're constructing an index that has no exposure to the sectors themselves. And you're trying to isolate the pure value or the pure growth. And you're trying to ultimately decide what you want to root for. You're absolutely right that you can slice and dice the data in a lot of different ways, and Tony's much more of an expert at that than I am. So Tony, how would you do it?
Well, definitely when in industry, I'm talking about industry, people do actually compare whether it's a sector neutral or sector non-neutral. Over the past 5 years, what I have seen is like a lot of hedge fund or institution, they tend not to do the sector neutral, but rather do more of non-control for the sector. Because thinking about the performance over the sector neutral versus non-neutral, what we have seen, apparently, one key topic that we cannot avoid is the definition for the growth and value over the large cap domain, especially fan stock. Now, if we, for instance, like Facebook, if we look at the like a PS multiple or PE multiple, which has been traditional used industry to define Facebook, well, it's like price to sales maybe just a 7, similar to Apple, price to sale like 6 to 7, right? Even the PE multiple is just 12 to 17, depends on the period over the 12 months. Now, people actually tend to think, if we, in people's intuition, if we ask people, is Apple a value stock or Facebook a value stock? A lot of people would have a counter intuition, this might not be the case. However, if we use the sector neutral, or even we use this like universe or S&P 500 to do not control for the sector, this actually might tend to be the case. They are actually suddenly become the value stock, value domain. And what we have known that because they have superior performance over the past 10 years. Now, any index consistent of the FAN stock, we tend to outperform for the rest of the components within the S&P 500, right? If we do control for the sector neutral, sometimes we have to match with the weighting over the portfolio versus the index. Then we have to eliminate some of the holding for some of the component for FAN stock that we just talked about, like Apple, 14%, Facebook, like 7%, Google, 7% in Russell 1000 as well. If we do control the sector neutral, we might not be able to hold as much as what we want. However, with those components, actually really outperform the rest of the index. Now, this actually can distort how we actually look at the value and the growth performance over the past 10 years.
There's just a couple of things that I would add to that. And so Lotta, to your point before about what's priced into a market or what's priced into any sort of index. When we look at it and we say, if we try to construct it on a more of a sector neutral basis, we can think that in some ways that's how the active managers might look at things, because they will look at within the sector, they will look at securities relative to each other. And so that's why I think when you look at it on a sector neutral basis, you're not seeing a relationship relative to the interest rates, because that a lot of that active management component will have already been priced, built into the price, which is one of the reasons why in the short to medium term, valuation has no statistical significance to the performance of a security, whereas over the long haul, it's the only thing that matters. And I think most people are lost on that over a 1 to 2 year horizon, valuation doesn't matter, because a lot of it as the good news gets priced in. But over a 10-year horizon, the price that what you pay has a very significant performance or impact on the performance that you'll see. But I think that's also one of the reasons why, if you look at it on a non-sector neutral basis, that's why there's a much better relationship versus interest rates, because ultimately what we're saying is that different sectors do well at different points in an economic cycle, and interest rates are somewhat reflecting the economic cycle. And so when you bring in those sector effects, all you're really seeing is the economic cycle impact interest rates and impact different sectors. And you're taking out the what's priced in effect to that.
That's a good point, because otherwise people would probably say something to the effect of, well, regardless of you bucketing it up in a different way, it's still the fact that some companies are more on the value growth side. I don't care that I end up with more companies in some sector in the growth bucket versus the value bucket. But it goes back to this, well, there is this other thing that they're affected by being in a certain sector, that like growth and value is not the be all and end all. And by the way, when we think about universe of buckets, we're already taking a smaller bucket than the universe, so to speak, by taking, if we're talking about the US, right? Like we should be talking about the whole world. and what within the world can we actually include there? Well, we usually think about some kind of global investable market bucket, but even that is very constrained. So I can get very philosophical about this, but I won't.
Well, so, even if we're looking at the US, we should probably look at the Russell 3000 instead of the S&P 500, so that we're looking at all stocks and not just all large cap stocks.
Right.
Yeah,
right.
exactly. So Lotta, Richard, what you just comment, actually maybe think about one sector in particular, the energy sector, right? For any investment manager over the past 10 years, like if we actually we have the sector neutral, that which basically means that you have to hold some holding or component within the energy sector. Now that actually apparently will become very disastrous not until maybe the end of last year, right? The energy sector. Now, if we have non-sector constraint, most hedge fund manager or institution would not hold the energy company at all. That actually creates something that from maybe academia point of view is the risk premium over here, especially in the tightening cycle, together with inflation keep going higher. The energy sector with the other commodity actually might tend to outperform the rest of the sector, including the tech sector, Apple, Google, and telecommunication, right? This actually turned out to be a very interesting phenomenon tying to what we are discussing today about growth and value. I want to maybe hear what your guys thought about that.
I would just ask you to clarify what is the mechanism behind it outperforming? Why energy should outperform?
Well, the outperforming is just using the performance, just average return, maybe just starting from the end of last year to maybe the end of January. We can compare the sector performance within the S&P 500 for within the same period.
Mm-hmm.
That's if we look at the performance of the energy sector by itself versus the technology sector's performance, for instance, that if we look at the relative performance, the energy sectors actually tend to do much better than the rest of the tech over the past 1 or 2 months, right?
I would say that as an advocate of top-down investing, where the economic cycle matters tremendously to the performance from the different sectors, that what we're seeing really is the fact that the energy sector performs extremely well in periods where inflation starts to move higher. Now, you don't notice the relative performance as much when growth and inflation are both moving higher, when you see real GDP growth moving higher as well as prices, because the equity market overall tends to do fairly well. And so technology and some of the leadership being in technology would have masked some of that effect. But now as growth is expected to start to come a little bit lower and normalize, that tends to be a period where you get a lot more mixed returns in the broader equity market. And so some of that leadership in tech starts to suffer. But because prices are still staying high, maybe stubbornly high, commodity sectors and material sectors tend to still do very well in that environment. And that's exactly what we're seeing right now. We're seeing kind of a classic business cycle investing phenomenon with energy outperforming technology over the last several months.
But to get back to the points that you were making in your slides here, Rich, and you were comparing, how different the picture is, whether you look sector neutral or not. By now we understand what that means. Does that mean, what's the implication here? Does it mean that, hey, the value factor is real, so to speak? It does tell you that you should be outperforming if you're a value company. And most people should probably be value investors, unless you're trying to do something very short-term kind of navigation, short-term trading.
Well, we know there's a lot of different ways to make money in the markets, right? And so I wouldn't suggest that one way is better than the other. But I think it's important for people and for our members and for others to really recognize is know what you're rooting for, right? If you're looking at the construction of value versus growth that doesn't neutralize by sector, you're rooting for a couple different things, right? You're rooting for value to work, but you're also rooting for certain sectors to work relative to others. Whereas if you're isolating the sectors, then you're at least rooting for value as a factor to work relative to growth. It may not in the short term because, as you said, the markets may be efficient and active managers may have taken away some of that alpha in the very near term. But at least in that case, you're only rooting for one thing instead of rooting for a couple different things. And so I think ultimately this is one of the mistakes I've seen a lot of young analysts and portfolio managers make in their career is they don't really understand what they're rooting for, and they don't realize that there might be headwinds to their investments because they have factor or sector approaches as well as just their idiosyncratic analysis.
Exactly. What Lotta just asked a question is very interesting. I think it's very worth of discussing as well. Rich just comment out about some of the lessons, or especially some of the experience that in the hedge fund industry over the past maybe long haul 20 years, like what kind of investment style that investors should actually consider at this moment. And especially since like S&P has actually make a almost roughly about 10% correction by the end of January. Now, and of course, over the past few days, then the market actually rebound together with technology sector. We typically would use NASDAQ to present the growth stock, right? Especially when we actually, over the past few sections, we would talk about the growth stock holding by Kathy Wu. This is like a phenomenal funds over there, which also rebound over the past few days. Actually, now investor would ask the same question as what Lotta just now asked, is like whether the recent pullback to make the growth company actually like cheap enough to make the investment into the growth stock worth of owning for a trade at this moment, right? As a particular moment, right? There are actually multiple factors which you consider, including both the macro factor and micro factor. Macro factor, as what we have been discussing dramatically, like in the tightening cycle, whether the Federal Reserve or central bank will really take the hawkish actions in March and over the rest of this year, right? Now, the market anticipate the Federal Reserve might actually hike the interest rate 5 times. And Lotta, I know you don't believe that's going to be the case, or this is not going to be the case. Well, if this is not going to be the case based on what we just discussed previously, the growth stock based on the discount cash model should actually tend to have a higher valuation, or maybe tend to create a higher return in this environment. Or if the central bank does actually take very hawkish action, what we going to anticipate the terminal value based on what Rich is saying, discount back today would have a lower net present value. That's actually going to kill any play within the growth domain. However, we do need to emphasize right here, even in the growth domain, there's a divergence between the large cap growth versus small cap growth. This is some difference that I want to actually highlight and want to make investors aware about the major difference right here.
That's a good point.
A couple things I would add. I know we're getting a little long, but I would just suggest that, we are February 9th, and like you said, Tony, things have kind of recovered, but certainly in the very short term, sentiment and positioning is all that really matters to the expected return over a very short term horizon. Over a long term horizon, we know is that it's earnings that drive stocks, and the economy drives earnings. And so ultimately that's what works over a longer period of time. And in a year like this year, where whether or not we get the 5 or 6 rate hikes that are expected, it's realistic to expect that multiples probably will not expand very much. They may not contract very much either, but it's typically in Fed rate hiking cycles, we don't see the multiples of the market expand. And so really what investors should be focused on is whether or not a company is going to deliver earnings this year, because earnings are going to be what drives the stock and not multiple expansion.
Well, is earnings, we would think though that if we have a shock to the downside, say, of earnings, because people realize that growth is not going to be that high, then you would want the value side, right, rather than the growth side. And what doesn't work there in my mind is that if we think about a typical value sector like energy, that's considered a cyclical sector, one that reacts very negatively to bad GDP numbers and use on the growth side.
Well, what you'd really want in that situation is to not be in the equity market, but what you'd really want in that situation is to be long quality, regardless of the sector. Value and growth would not be the factor you'd want to look at. You'd want to look at balance sheet quality, but that's probably for another podcast.
Yeah, let's take the ratio of 2 other factors somewhere else.
A great example for Lotta just mentioned about is like we see the low the growth rate slow down. What's going to happen to the valuation of the stock? The Facebook Meta platform, in another case, is a great example. Well, this is something that the market did not anticipate to see. Like Facebook could actually tank, went down almost 25%, right? The second day after the earning was posted. So that's one typical example of when investors see or react to this kind of earning growth slowing down. Whether we are going to see the for the rest of the year, the earning of the companies, especially within the S&P 500, would actually make the huge difference.
Yeah,
definitely, I agree. We probably it's worth of discussing for the next theory or podcast as well.
it just becomes very interesting when we think about value growth, and in terms of we switch to talk about duration. So we talk about, just like a bond has duration, you get the payoffs in the future. We have equities also have their duration, depending on when you think you're going to get your payoffs. And usually what people have in their mind, right, to get a little bit academic, is this kind of what I call the growth retention model, which says that if you have your ROE, right, return over equity, times your retention rate, which is 1 minus your payout ratio, okay? So those two components, how much you're retaining out of your earnings is how much is whatever is left without after the payout. Then you get your growth rate, and there's this sense, right, that therefore, like, if I have a high growth one, that means that growth company, that means they're not paying out dividends. So I'm not giving the dividends now. I'm giving them the future. I'm getting them as appreciation of my value, right? As opposed to like not income, but value appreciation in the future. And it's specifically interesting when you bring up something like Cathie Wood, and I'm thinking, like, if you have a bucket of, say, some Bitcoin in it, right? People will think about, well, anything that is expectation of the future is growth. Well, if you got something that people want to call a currency, what's the duration of Bitcoin? I would say the duration of Bitcoin is 0, because it's a currency. If you think it's a currency, you're going to roll that as quickly as you want. So anyway, any parting thoughts? I hope we've given our audience a little bit of feeling, both not only in methodology, but what it could mean when we're thinking, actually looking at the market, looking at some graphs. I hope some people, by the way, if you're listening to this in your podcast app, we wanted to make it a little bit interactive to look at pictures. I hope you can still follow, even if you don't have the picture. If you want to see what we've been showing here, please check out the YouTube video. If you search on YouTube CFA Society Chicago, you'll find all the videos that we have here, and you'll see, talking heads mostly, but we're trying to show some pictures too. Any parting thoughts, guys, before we wrap it?
I would just say my parting thought would be, always know what you're rooting for. I think too often we throw around labels of what's this and what's that, but try to understand the root cause of what you're rooting for in your investments, because I think trying to bucket things without really understanding what's driving the performance of those things can be dangerous.
I agree with Rich, especially then, like, we have to really understanding the driving factor, especially in this year in tightening cycle. The earning growth rate for any corporates within the index actually will make a huge difference. Even we based on the traditional value or growth factor, that it may not be just as simple to say if a company belonging to a value based on the traditional factor analysis, that we actually would lean toward this will be a value investment. I think this year, when Federal Reserve might need to actually increase the rate for its policy or inflation control, the earning growth would still be the key drivers behind the expected return or even the future return for the rest of this year.
Some wise word there. Thank you so much for joining me, and we'll talk to you again in a couple of weeks.
Thanks, Lotta.
Yeah, thank you, Lotta. Thank you, Rich.